Ladies and gentlemen, this, of course, was an extremely hard act to follow after His Royal Highness Prince Charles, but I think we have just the person to be able to do that. Our next speaker is certainly one of the most well-known and respected people in the financial industry today. Douglas Hodge is PIMCO's Chief Executive Officer and a Managing Director of the firm. He served as Chief Operating Officer from 2009 to 2014. He's also on the PIMCO's Executive Committee and on the Global Executive Committee for Allianz Asset Management, the governing body of the asset management for the Allianz Group. We've asked Doug to set the scene on the economy by providing a macro view on markets as well as the megatrends to look out for the medium term. I think this will give us a very useful market background for all the discussions that we'll be having later on here at the PRI in person. So it's an honor to welcome Doug to this stage. We're looking forward to your presentation.
Martin, thank you. And as I was listening to His Highness, I kept thinking, he's stealing my speech. Somebody ought to talk to that guy. But I will do my best. And I think his words are both insightful and instructive. And I'm going to pick up on some of the themes that Prince Charles just spoke to in terms of as I look through the lens of PIMCO. And just as a quick introduction as to who we are, and I imagine many of you in this room know of us, but very briefly, we invest primarily in fixed income, in bonds, fixed interest, as it's said here in the UK. We manage $1.5 trillion of assets for our clients who are all over the world, from the largest sovereign wealth funds in the world to individual investors who commit a portion of their wealth to us to invest on their behalf. So we span the world, both from where the money we receive, the wealth we receive in order to invest, and then where we deploy those assets. We're investing in markets literally 24 hours a day, 7 days a week. So Martin, thank you for that kind introduction. And before I begin, I would like to thank the PRA for hosting this important conference, and I think they can be proud of the awareness and commitment to the principles based on responsible investing that they have fostered through hosting this conference, as well as the myriad of activities they undertake throughout the year with the purpose of growing and improving PRI. I'm honored to be speaking here at this 9th conference. And what I'm going to talk about today is that we live in a world of low and flat. Low and flat. Of course, what I'm talking about are low interest rates and flat yield curves across the world's developed markets. Today, the U.S. Treasury bonds are currently yielding 2.15%. It was only a few weeks ago that those yields fell below 2%. 10-year Treasury yields below 2% in the United States. Similarly, 10-year bunds, German bunds, are currently yielding 65 basis points. And here in the UK, 10-year gilts at 1.8%. And Japanese government bonds, JGBs, are trading at a meager 34 basis points. So what's going on? Perhaps the biggest surprise in the markets this year is that bonds have far outpaced stocks with over a 4% return through last week as measured by the US bond market versus the S&P 500. And of course, as we've all witnessed over the last few weeks, volatility has exploded again. I'm going to spend the next 30 minutes or so sharing an investor's perspective on what's going on. I'm going to speak to PIMCO's view of the world and our new neutral forecast. Importantly, I'm going to address the implications of what low and flat means for asset returns, and importantly, how sustainability will need to be considered in this uncertain macroeconomic environment. And in the true PIMCO fashion, I'm going to move fast. So let's go. Coming out of the financial crisis in 2009, PIMCO coined the period the new normal. Our new normal forecast had 3 elements. First, we said there would be no reset coming out of the financial crisis. we would not and could not simply return to pre-crisis conditions of robust economic growth and high asset prices. And in the statistical context of normal distributions, we would not return to the old mean. Rather, we were on a course to the new normal. Secondly, the journey to the new normal was going to be bumpy. We had to acknowledge and manage for heightened volatility and fat tails. We also knew that this would be a macroeconomic environment in which governments would spring into action to try to influence outcomes through monetary policy, fiscal policy, and increased regulation. And then we believed that the extraordinary scale of this policy response precipitated by the crisis was going to continue. Although we expected that over the time period that policy would morph in ways that frankly it has not. We knew then that exiting quantitative easing was never going to be easy, and that the period, and like the period following the Great Depression, there would be a wave in what has become a tsunami of financial regulation, and that was coming. So after 6 years, I would say that our new normal forecast got it right. Perhaps not in every last market prediction, but on the whole, the period we envision has unfolded. We have not returned to pre-crisis growth trajectories in any economy significantly impacted by the crisis. We have had more volatility, particularly in Europe, as the Eurozone flirted with its own banking and debt crises. And indeed, we continue to live in a world characterized by unconventional monetary policy and growing prudential regulation. So now, our new normal forecast has evolved into the new neutral. Taking the Fed's blue dots, the expectation is that real interest rates will rise towards 1.5% to 2%. That would carry nominal interest rates up to 3.5% or 4%. Though the Federal Reserve projections have already been revised lower over the last 12 months, at PIMCO, we simply do not adhere to this view. We do not see the catalyst for growth across the global economy that can support this rate structure. Rather, developed countries will be confronted by the headwinds of the 3 Ds: debt, deficits, and demographics. There remains a large stock of debt across the developed economies, and as we have learned that regardless of the rate of interest on that debt, the stock of debt influences both the lender's willingness to extend credit as well as the borrower's desire to further stretch their balance sheets. Deficits, or more so deficit reduction and austerity, have become the watchwords among fiscal policymakers. No longer can we expect the fiscal agent to prime the pump as they once did. And now we face the inexorable force of demographics. With regard to our aging populations, there seems to be a tipping point where creating organic growth becomes exceedingly difficult. More importantly, are our older citizens adequately prepared? In this world, the neutral real rate of interest, not just in the United States, but broadly across the developed economies, will remain low, in the 0 to 1% range. In this world, low and flat persists. For the last 6 years, central banks have been in a state of hyperactivity. Their first action was to lower policy rates to near zero levels, where they remain today. Then, in 2009, they began to expand their balance sheets, and thank goodness they did, as their aggressive actions saved the global financial system. But they have never looked back. Today, the collective balance sheet of the Federal Reserve, the European Central Bank, and the Bank of Japan exceeds $10 trillion US. But as Sir Paul Tucker, the former deputy governor of the Bank of England, reminded us at a recent PIMCO conference, monetary policy has its limitations. Easy money can only pull consumption forward to the extent that it can provide buoyancy to the lending markets. It cannot, in and of itself, create sustainable, organic economic growth. So far, we've looked into how governments deployed monetary policy to influence economic outcomes. Now let's turn our attention to fiscal policy and leverage. In addition to the extraordinary monetary policy response, governments have been very active since the financial crisis. Looking back, the last 2 decades have been marked by an acceleration of debt accumulation that seems to show no signs of going away. Today, the global debt outstanding has soared to over $90 trillion. The overall system has not deleveraged since the financial crisis, although we have witnessed a shift from private sector debt to public sector debt. This engagement from the public sector was crucial to avoid debt deflation. While the focus today remains on fiscal austerity, some governments, the US and the UK in particular, have been retreating from some of their most aggressive policies, and as they have reduced fiscal balances from their record deficit levels seen in the immediate aftermath of the crisis. Now we see a global economy as no longer restrained by private sector deleveraging. Rather, we are learning to live with record debt levels of public and private debt, but without the cushion that would be provided by more rapid growth or higher inflation. With the private sector no longer focused on deleveraging, we are seeing the engines of credit growth kicking in again, but the sources of funding are changing. Bank lending, particularly in Europe, is no longer as available as it has been in the past. Historically, bank funding has been the dominant force of credit growth in Europe, with about 80% of debt finance being provided by the banks. This is in comparison to the United States, where 80% of debt finance comes through the capital markets and only 20% through the banks. Going forward, we see an increasing array of non-bank actors providing a rising share of funding to the corporate and real estate sectors. Regulation has been the final lever governments have used to influence behavior and outcomes. Similar to the policy response following the Great Depression, there has been and continues to be a wave of financial regulation enacted with the goal of never allowing another financial crisis from happening again. And in response, there have literally been tens of thousands of new rules created since the financial crisis. They have ranged from as broad as the creation of new market structures, such as central clearing for derivatives, to rules governing the behavior and compensation of certain individuals in leadership and risk-taking roles at corporations and financial institutions. And in the process, the regulatory frame has shifted from a principles-based regulatory system to an increasingly rules-based approach. And while I will make no prediction as to whether the new regulations will ensure we never have another financial crisis, there is no question that as a result of regulation, along with the combination of public policy and private sector responses, the financial system is safer today than it was before the financial crisis. Yet we must also acknowledge that a portion of that risk has been transmuted into price risk or market volatility as balance sheets of the major banks and counterparties have been reduced and market liquidity has been diminished. For the last 3 decades, we've been in a super secular cycle of disinflation and declining interest rates. Over this 30-year period, we've tamed the inflation beast through responsible monetary policy, coupled with the extraordinary spread of revolutionizing and transformational technology that has lifted productivity for literally billions of people, along with political and economic regime change that has spread democracy, and perhaps more importantly, from an economic perspective, capitalism, to some of the largest, most populous countries in the world. As a result, over this 30-year window, interest rates have come down. Shown here are U.S. Treasury rates that peaked at over 15% in the early 1980s and then began their secular descent to today's exceptionally low levels. Meanwhile, the capital markets literally exploded. As the yellow line illustrates, growth of the non-financial debt markets. This period was not only good for bond returns, but also fostered a period of unprecedented economic growth and global prosperity that lifted prices and returns across all financial asset classes. But how you run the race is not only determined by the finish line, but it's also where the starting line is. Today, That starting line is at 2.2% on U.S. 10-year treasuries, 34 basis points on Japanese government bonds, and highly elevated valuations across many of the world's equity markets. So where do we go from here? If we simply plot the Barclays Aggregate Bond Index, we see that it has a 92% correlation with prospective 5-year returns from bonds. This is just simple common sense and the arithmetic of duration. Today, with the yield on the Barclays Index at 2.4% and its duration of 5.6 years, this would suggest that over the next 5.5 to 6 years, investors can expect to receive about 2 to 2.5% return from their bond portfolios, give or take 25 or 50 basis points. This is obviously far lower than the 6 to 8% or even higher returns delivered in years past. But it's not just about bonds. We should also temper our expectations about equity returns as well. Using the Shiller PE ratio, which takes the trailing 10-year earnings divided by the current price as a measure of long-term value, we see that over this super secular 130-year horizon, the long-term average of this PE ratio has been 16.5. Yet as of the end of August, the Shiller ratio of the S&P 500 stood at 25.8 in the 90th percentile. Indeed, the chart to the right shows the prospective 5 and 10-year returns for various Shiller PE ranges. Looking forward from here, equity returns portend to be equally meager. One of the theses of the new neutral was that though we live in a multi-speed world, we will experience converging growth rates in the years ahead. Here we plot the difference between emerging economy and developed economy growth rates. Remember how in 2007 and 2008 we were debating whether the emerging economies would decouple from the crisis, during the crisis? Of course, since then we've learned that all economies are interconnected through trade and finance. Over the last decade, the emerging economies have been important contributors to global growth. But looking forward, it is our expectation that growth curves of the 3 largest emerging countries, Brazil, China, and Russia, are likely to flatten, bringing about a convergence in growth rates. And indeed, the recent political and economic challenges in each of these 3 countries is being revealed on the front pages of our newspapers nearly every day. But GDP growth does not tell the whole story. Each of us who operate in the financial sector understands the dynamics of the stock and flow of global wealth. But let's put some numbers on that. Between North America and Europe, we hold nearly 2/3 of the world's wealth. Add Japan, we approach 3/4 of the globe's accumulated savings. While the stock of wealth is in the developed markets, the wealth creation process is alive and thriving in the emerging and frontier markets. This wealth creation will be a major influence on our financial markets, asset valuations, and consumption trends. However, we must also acknowledge that this will be uneven. By their very nature, emerging economies often lack the full spectrum of political, economic, and social infrastructure and institutions that promote stability. While the secular tide of growth continues to favor the emerging world, with their generally positive debt dynamics and younger populations, they will remain prone to the ebb and flow of both internal and external disruptive factors. So let's just recap. We're living in a world of low and flat, and we're forecasting low growth and low financial returns. We remain in a process of adjustment to higher debt levels, structural deficits, and changing demographics. Governments are fully engaged with the aim to influence economic and social outcomes through monetary policy, fiscal policy, and regulation. In such an environment, the margin of safety has been reduced for corporations and investors. In the past, some people have looked at ESG investing as being disconnected or incongruent with their fiduciary duties. It was seen as a type of investing that was reserved for what I would characterize as the do-gooders. These were investors who were prepared to compromise. They were prepared to relax their strict adherence to their fiduciary duty in order to accomplish a set of important social objectives. This was also construed as ultimately having to sacrifice investment return. The world has moved. Just look around you in this room. We have over 1,000 participants at this year's UN PRI in-person conference. The membership of the UN PRI has grown to 1,380 signatories who collectively oversee $59 trillion in assets. These facts serve as ample testimony that ESG investing is gaining in importance. The attitudes of society towards ESG investing are changing, and changing rapidly. More importantly for us, who are investors, fiduciaries, charged to oversee the investment of other people's wealth, the conflict between our duty of care to those we directly serve and our broader obligations to society to allocate capital in ways that fosters the 6 principles of responsible investing are no longer in conflict. Let me describe how at PIMCO we have not only reconciled this conflict, we have embraced ESG investing as intrinsic to our broad investment process. First, we need to establish that ESG risks are real. They can cause discrete and sometimes severe losses for companies and capital. Hence, it simply makes good business sense to focus on mitigating ESG risks. One natural ESG investor is the property and casualty insurance sector. PIMCO's own parent, Allianz, the largest P&C insurer in the world, is a prime example. They, along with a broad spectrum of P&C insurers and reinsurance companies, are actively involved in improving industry standards and raising awareness for climate-related risks, and for an obvious reason. Looking at the numbers of loss events due to the forces of nature, we can clearly see the increase over time. While the number of geological events, in blue, remains fairly constant, the number of climatological, things such as extreme temperature change and droughts, hydrological, floods, and meteorological, tropical storms and hurricanes, have risen precipitously over the last 35 years. While some outside this room may debate the sources of global warming, there's little argument among experts that many of these events are the result of the rise in the temperature of the Earth's atmosphere. And as you would expect, the trend in loss amounts has been ever increasing over time. These events have led to substantial climate-related losses globally, often exceeding $100 billion per annum. The business response from the insurance industry has been to engage in activities and to commit their capital in ways that reduce global warming and mitigate its effects. These include raising awareness of the environmental risks and long-term effects of climate change, and allocating capital to sustainable businesses and projects such as renewable energy. However, the environmental risks are not the only risks to consider. Social and government issues can materially affect corporations as well. On the social side, there is a significant risk when substandard worker conditions and safety standards interrupt supply chains, or even worse, cause physical or environmental harm. On the governance side, for example, we have seen the litigation payments from financial institutions climbing to over $275 billion since the financial crisis. As investors, it is therefore in our interest to analyze and evaluate ESG risks when making investment decisions. While we probably all would agree that ESG issues should be considered in an investment process, the challenge is to fully integrate and embed them into investment decisions. I would suggest that at PIMCO we have considered ESG risks and opportunities long before ESG became part of our vocabulary. We've been focused on identifying the longer-term trends and incorporating variables beyond the latest economic releases and corporate financial statements for decades. For those of you not familiar with PIMCO, at the cornerstone of our investment process, each year we conduct our secular forum. At this 3-day session, we assess the longer-term trends in the global economy and markets. Our goal is to extend our perspective beyond the traditional drivers of the business cycle and the latest gyration in the financial markets. To challenge our thinking, we invite in external speakers to address a wide variety of topics. It is in these discussions that environmental, social, and government issues first begin to enter into our dialogue. To name a few over the last several years, we've invited Jared Cohen of Google Ideas to share with us the effect of social media and technology on emerging societies. With Chrystia Freeland, we explored the implications of rising income inequality. And with Daniel Yergin, one of the world's leading energy experts, we discussed how the outlook for energy and its implications for geopolitics. Each of these topics directly related to ESG issues and served as important inputs into our new normal and new neutral secular forecasts. Looking forward, I would expect that any long-term investment outlook for the global economy and the markets will need to even more explicitly embed ESG analysis. The world would be faced with more and even larger disruptive changes and innovation. Against this backdrop, population growth and rising wealth will create a rising demand for natural resources. We've already seen disruptive change in the energy markets, mainly driven by fracking. The U.S. has increased oil production by almost 5 billion barrels per day over the last 5 years. This 5-year production increase is only surpassed by the new oil discoveries in Saudi Arabia in the early 1970s. As a result, the United States is expected to transition from a net energy importer to a net energy exporter. Clearly, this transition has had and will continue to have profound effects on the energy markets, green technology, and geopolitics. When we think of G in ESG, it usually is with regard to corporate governance. However, as I explained earlier, the role of government has increased in the post-financial crisis period. The concept of sovereign governance will be increasingly important as governments continue to attempt to manufacture outcomes for their populace. Yet it is not clear that the infrastructure of sovereign governance designed in the 20th century is appropriate for today. More recently in Europe, we have seen the effect when governance processes were inadequate for the situation at hand, as evidenced here by the number of meetings of the European Council and European and unscheduled meetings by the Euro Summit that have been dealing with the Eurozone crisis since 2011. Similarly, with the secular rise of the emerging world, particularly China and India, other 20th century multinational frameworks and infrastructures will need to be reevaluated. Meanwhile, the fast pace of technological change and its rapid deployment on a global scale will redefine and stress corporate structures at an accelerated pace. These will also have broad social implications that we have yet to fully understand. The rise of the shared economy has been impressive. Airbnb has created more rooms in its 6 years than Hilton amassed in nearly 100. Similarly, Uber is redefining ground transportation, yet with an array of attendant regulatory and social issues that will need to be resolved in the period ahead. Technology and science are also changing demography. Rising longevity will place new demands on our social infrastructure that will influence and ultimately shape public policy. These are topics and trends that simply highlight the importance of integrating ESG analysis into any long-term investment process. Simply stated, ESG investing makes sense. Another important demographic trend to consider is the rise in the influence of the next generation, the Millennials. Studies have shown that they have considerably different attributes and priorities than their parents. And why not? Born between 1980 and the early 2000s, they have grown up in the digital age. They gather information and form connections through digital relationships and social media. With regard to consumption, Millennials are nearly twice as likely to consider sustainability in their purchase decisions as other generations. These buying preferences will exert new forces and launch new trends that will determine the next round of corporate winners and losers in the 21st century. On the investment side, millennials will also invest according to their values and beliefs. Here, millennials are also twice as likely to consider sustainability factors when allocating capital. Such behavior will influence corporate valuations, and successful investors will have to have strong ESG capabilities. And let's not underestimate the coming impact of the millennials on society. Already, the millennials number as large as the baby boom generation. They will be the wealthiest generation in the history of the world. The impact of the millennials will become even clearer when considering their place in society in the future. This generation will comprise 75% of the global workforce by 2025. They will account for over $1 billion in annual consumer spending in the United States alone. And they will inherit over $30 trillion of wealth. They are our investors of the future. So as I conclude, let me share with you 5 beliefs. 1, we believe and are committed to the principles of responsible investing. We believe we can meet our fiduciary responsibilities and be socially responsible to investors without conflict or sacrifice of return. We believe that an investment process that incorporates ESG factors into its decisions will serve our investors and our organizations well and will be a key ingredient for our success going forward. And finally, we believe the business rationale for sustainable behavior and investing is as strong and increasing as the millennial generation increases in importance and wealth. And we believe ESG investing is smart investing. Thank you very much for your attention.
So thank you very much. That was very insightful and I think a great way to start the PRI in person. We have time for a couple of questions, so let me just start with one. You mentioned the recent volatility in equity markets, and how should we interpret that? Is that just noise, or does it have real informational content that has affected your longer-term outlooks?
Well, I think you have to look back at one of the sort of precipitating events, which was that China decided to devalue its currency, the yuan. But I interpret that actually a bit differently, because if you even take a step back even earlier than that event, which sort of triggered some of the sell-offs in the global equity markets, it was only 1 week earlier that the IMF had issued an assessment of the Chinese financial economy, and in particular, the readiness for the Chinese currency to become an international reserve currency. And their basic assessment was, it's too soon, not yet. And they spoke to the inflexibility of the exchange rates and some of the other characteristics of the Chinese currency, and it was then 1 week later, they changed the band in which the central bank would manage the currency to a much wider band, which then immediately allowed it to depreciate in value, which triggered a whole host of responses across the financial markets. I think it's instructive. It's instructive because it's the world in which we live. One, as I noted earlier, the balance sheets of the banking system are considerably smaller. And the banks have typically been the providers of liquidity to the financial markets. They serve as that buffer. So as their balance sheets have shrunk, their ability to serve as that buffer is diminished. Meanwhile, we start in a condition with high debt, low growth. So small changes in policy, and this was not a small change, I would argue that was a very substantial change, can be very disruptive to the markets. Is it a change in the long-term direction of the global economy? Probably not. Probably not. The U.S. is, albeit slow growth, but sturdy. We see some signs here across Europe and some countries, certainly the UK and others, of a reemergence of growth. We are still challenged by the threat of deflation, and that's going to be with us for a while. And there's sort of good deflation and bad deflation. Good deflation is when we're more productive. We can produce the same amount of stuff more efficiently. We invest more efficiently, we produce more efficiently, we consume more efficiently. That's good. That's good disinflation or deflation. Then there's deflation where there's insufficient aggregate demand to meet aggregate supply on a global basis. And that was certainly revealed and contributed to the crisis, and that came partially and largely as a result of too much debt. We still have a lot of debt. So the threat of deflation remains certainly on our minds, but it's not quite as acute as it was. And then finally, to my comment of a moment ago, yes, there's been a lot of financial regulation in every country that was impacted by the crisis, in every market. And while many in the financial in the financial industry will rail against all this regulation, and some of it is good regulation, and some of it probably not so good. But on the whole, the regulation, along with public policy, along with the private sector responses, has made the financial system a lot safer. More volatile, perhaps. But that's price risk, that's market risk. That's market risk. That's not systemic risk. And there is a vast difference. So the system is safer today.
We have time for one or two more questions. We have one over there in the back, and then one there in the back. And I think...
Hello, Peter Cripps from Environmental Finance magazine. I wondered what your view is on the green bond market and whether you've bought many green bonds to date.
Great question, thank you. The green bond market, and His Highness spoke to the green bond market in his remarks. So let's put some context on that. The green bond market is about $600 billion in size. So that's on the total denominator of 16 trillion. That's relatively small. Relatively small. It also trades generally at some pretty tight yield spreads. So it needs to mature. Do we invest in green bonds? We absolutely do. But we look at them in the context of all the other choices that we can make with respect to an individual client's portfolio. But we believe that companies that practice ESG, that are principled in how they manage their business, are good companies to invest in. Prince Charles remarks about that you can, even in a passive portfolio, if you choose those companies which are behaving responsibly, you get a higher rate of return. There's a reason for that. Those companies tend to be good at making decisions, good business decisions, and they realize that being environmentally responsible, practicing good governance, caring about the communities in which they operate, in which they serve, is good business. And we believe the same. And that's part of our thesis in terms of looking at companies and how we invest on behalf of our clients.
Thank you. We have final question in the back.
Gianluca Manca, Eurasian Capital. A question on, I'm here. A question on GOVs and sustainability. Should you choose only one single parameter to add to your analysis among E, S, and G, say, for instance, the ability of preserving the natural capital in a country, or the efficiency of the healthcare and educational system, or the corruption index, which one would you choose?
Well, I guess I would choose all of them, but I'll just give you the one that comes most quickly to mind, which is sovereign governance, the regulation. And whether it be how a country interacts with other nations, and I use my example of the Eurozone in that context, or how its regulation is developed and implemented within its own country, can make all the difference. Whether capital is coming into that country, whether capital is leaving that country, those I'll call systemic decisions can overwhelm all the good things that a good company might do. So I would look at the sovereign governance before I would, and of course it's environmental regulation largely comes through central government. So again, I would look at sovereign governance as my first variable.
Jay.
Thank you. Martin, thank you.
Thank you. Thank you very much. Thank you for coming. I appreciate it.